They should ask for an extension, get all the paperwork in because they want to see the HUDs now and all that, and then they can get it out till October so that they can get it basically 2009. They don't have to wait a full year to get the credit. So we know that that's out there. Now you know they have this HEMP program, okay, which is the Homeowners Affordability Modification Program. It has been somewhat of a disaster, all right? Now the reason why it's a disaster is because only 7 people have been able to qualify to get it. So just quickly to go over it, you can be in default, you can be current, you can be in foreclosure, it can be any kind of loan. It has to be a principal residence owner occupied, 1 to 4 units. The loan can't be more than $729,750. The biggest thing is this. You have to have a mortgage payment that was at least 38% or greater than your gross monthly income, all right? Oh, and by the way, you have to be working, because if you're not working, you can't continue to make a mortgage payment, all right? So now, a lot of people, and this was the goal, they're going to bring you down from 38% to 31% of your mortgage, all right? And so they tried to do that with people. A lot of people, it didn't matter. You could bring them down to 31%. They still couldn't pay the mortgage payment because most of them couldn't make the 3-month trial period. The second thing is, even if you brought them down to 2% and you elongated it 40 years, a lot of these people are underwater 50%. And so what they say is, I don't care if you give me a 31% mortgage. Take the house back. I don't want it. It's going to take 10 years to get back what I lost. You can have it. You make the mortgage payments. So it hasn't been a really successful program, all right? Those that are on it, they put you on that new rate for 5 years, and then on your 5th year anniversary, which is what other people don't like, they bring you back in, and whatever the new rate is on the 5th year anniversary becomes your permanent interest rate, and they bring you up 1% a year till you get there. So if 5 years out, it's gone from 2%, and all of a sudden interest rates are 8 or 9, you're going from 2 to 8 or 9, they'll bring you up slowly, but you're still going there. So it hasn't really worked. Part of that HEMP program also was a refinance program. That could only be Fannie and Freddie. They basically left it at 417. It basically, nobody basically, especially on the coast where we have all the people that need it, could qualify for those. And so basically that one didn't work at all. So now they've come up with something, all right? Now let me tell you what I think they're trying to do now. I am going to show you this graph. See this graph? Okay, can you sort of see it? This goes back and shows you interest rates and basically mortgage loans, and it goes all the way back to 2007. I don't think you have it, but I'll make a copy before I leave. This gray area here were all the subprimes. So you see, starting in 2007, what came due and how much of a concentration we had of subprime. We are now right about here. So you can see there's very little subprime left. So those are the people that all had to go into default, foreclosure, and some short sales because they couldn't, no matter what you did, get any help to remod or refi. But now look where we're going. We're going into this group here. Now what are these? These are ARMs that are coming due now. These are the people that have been current on their loans because a lot of them had no interest loans and a lot of them have been able to make their payments. They took them out at the height of the market, 2006 and 2007, and now all of a sudden they're coming due, all right? So we know there's at least 2 million of them probably coming due in the next 18 months, all right? And we know that 7% of those may be able to be remodified, but what do you do with the rest? Today, there's 50% of them are behind at least 60 days. 3 and 4 are underwater, all right? And 1/3 have a combined loan-to-value ratio of 150%. So we know that those people are going to be troublesome. So now, what do we do with those people? Foreclosure is not an option that's going to look good to them because they have been current on their loans. So the government now is going to start to push short sales, all right? So I want to talk a little bit about that because they are starting a bunch of new programs now that are going to basically start on April the 5th, and they're all having to do with short sales because the option for these people is going to be short sales. And so there's a whole bunch of new programs coming. The first one is a program that's called 09-52, all right? Now, people, and I'll leave you something so you'll know that it's actually true because this is all going to be lender voluntary. So when you call some lenders, they're going to say, oh, we don't know that program. It means they're not doing it. Now, I think all the big banks, because the governments own a lot of them, are going to push them to do this. So here's what 09-52 does. We have to go back now and change the way we talk to people about short sales. Because what we have said to people all along, and what the lenders have said to them when they've called, is stop making your payments, because until you stop making your payments, we're not going to talk to you about short sales. Well, see, these people have been basically current on their payments, all right? And so now this one says this: if you stay current on your payments for the last year and you choose a short sale, and basically then the bank comes in, the first thing they have to do is try to get you a remodification. They're going to be compelled to do that. Let's say you get it, fine. Let's say that you don't. And if you stay current on your payments during the short sale, so you're staying current, but they agree there's going to be a short sale, then when there is the short sale, if you walk away not owing anybody, you haven't signed a note to the bank, there's no deficiencies of judgment, then what they're going to allow under the 0952 is you will be able to walk away from that property free and clear, and even though you've been a short sale, you can go to a participating lender who will know your FICO score went down 100 points, will know you did a short sale, but they will look at and probably approve a new loan for you within the next month after the short sale. In other words, you're not going to have to wait 2 years to get back into the work and basically back into the home owned and buying environment. The reason for that is, if all of a sudden these 2 million people all walk away from these homes and they're doing short sales and they can't get back into the housing market for 2 or 3 years, what does that do to us with a pool of potential buyers? Now we've had the foreclosures, now we're going to have the short sales. It's too many people out of the market. So 0952, and I'll give you some information before I leave, I'll give it to Tom, he can make copies for you, basically addresses that. Now, there's another program out there that's going to basically call HAFA, all right? And it's the Homeowner Affordability Foreclosure Alternative Program, all right? Now this one is being set up by the government, and they're putting money in it from the TARP fund, so there'll be billions of dollars put into it. And this one is, how do we solve the problems we've had with short sales? Well, here's been the problem. The problem is you never even get to negotiate a short sale until the time you bring a buyer. That's when the bank starts to talk to you about terms, conditions, whether they like the appraisal, they're going to do another appraisal, and then the second is fighting, and the second doesn't want to agree with the first, and the buyer says, well, we'll throw some more money at the second, and the first says, no, we want the money if it's going to be more money. And we go back and forth, and it takes months to get these things done. So this program now is going to stop that, because what this program says is, what the banks that participate, the government is going to come in and give people incentives to get this short sale done and get it done up front. So here's what's going to happen now. You're a participating bank. There's a short sale. So you have a seller now. It's been determined this should be a short sale, not a foreclosure. So what the bank is going to do is they're going to sign an agreement with the seller. It's called an SSA, a short sale agreement, and everything is going to be negotiated up front before it even goes on the market. So the terms, the condition, the appraisal, the amount they're willing to accept, how long it can stay on the market, what the agents are going to get paid in the way of a commission and fee, and everybody's going to agree to that, all right? And then the second is going to be told up front, you can either have a payout right now of between $3,000 or $5,000, or up to 3% of the amount you're owed. Go away. Just get out of the picture. Sign off, goodbye. Or if you stay in, you have to agree that at the end of the day, you'll take that offer. So now everybody has agreed that they're going to do this short sale. That changes the terms for the back end. Now when it comes to the back end and everybody behaves and everybody does what they're supposed to do, then here's what happens. The first is going to get some money, at least $1,000 or better. The seller's going to get $1,500 because they cooperated with the short sale. It gives them some money to walk away with. And the second either got bought out in the beginning or they're going to get bought out at the end. So that's called the HAFA program, and it starts April the 5th. It's voluntary for lenders, but we already know that a lot of the lenders are going to do it. Now, there's another program coming out now, which is also going to be basically FHA. Fannie and Freddie are not participating right now in this program, but I know they will. This is the new one now that says,